Welcome back, ladies and gentlemen. After a very successful inaugural session, we now take you to the plenary session 1, and it would be about the customer-centric and responsible lending through fair, transparent, sustainable lending practices. Ladies and gentlemen, this session will explore the principles and strategies of customer-centric lending with the microfinance sector, focusing on creating fair, transparent, and sustainable lending practices. The discussion will cover key aspects of inclusive, personalized financial solutions, transparent communications, and ethical lending standards. This session will also address the challenges and opportunities in implementing customer-centric practices in diverse market environments. With those words, kindly join me as I invite our distinguished speakers of the session. Please join me as I invite the moderator of the session, Professor M.S. Sriram from IIM Bangalore. Very warm welcome to you, sir. May I request you all to kindly put your hands together as we also invite our speakers of the session, inviting DMD SIDBI, Mr. Sudatta Mandal. Warm welcome to you, sir. I request GM Reserve Bank of India, Dr. Mukesh Kumar, to kindly join us. Now inviting CMD Satin Creditcare Network, Dr. H.P. Singh. I request CEO Muthoot, Microfin and co-chair Sa-Dhan, Mr. Sadaf Sayeed, to kindly join us onto the stage. We now invite Chairman CRIF, High Mark and Regional Managing Director CRIF India and South Asia, Mr. Sachin Seth, to kindly join us onto the stage. I now invite CGM State Bank of India, Mr. Debasish Mishra. We request EVP and Business Head Microfinance Bharat Banking Axis Bank, Mr. Krishnadas Nair, and also inviting on stage MD and CEO Coverfox, Mr. Sanjib Jha, to kindly join us onto the stage. Ladies and gentlemen, may I request you all to kindly settle down, and may I just discuss few key questions that need to be addressed in this session. Is the present microfinance model customer-centric? If so, it is serving the interest of the individual borrowers to meet their aspiration. Can the present model of group lending can be made more customer-centric? And how do customer-centric lending practices enhance fair, transparent, and sustainable microfinance solution? Also, we would like to discuss matters around how can microfinance institutions balance client welfare with institutional goals to foster trust and long-term relationships. With those words, may I request the moderator of the session, Professor M.S. Sriram, to kindly take over. Over to you, sir.
Good morning. While in a panel, I would usually prefer to sit and speak, but this is serious business, so therefore I decided to stand. Two things. One, welcome to the 20th anniversary of the first microfinance crisis. This was in Krishna in 2005. Brijmohan sir would possibly remember. This is not the 20th anniversary of Sa-Dhan, this is the 20th conference of Sa-Dhan. I think Sa-Dhan existed far before the 2005 crisis because it played a fairly significant role in the 2005 crisis. Now, why am I saying welcome back to the crisis, 2005 crisis? The issues that were raised in the 2005 crisis in Krishna district were multiple lending, coercive recovery practices, and excessive interest rates. Does it sound familiar? It's the same set of issues that we are grappling with. So, in a sense, we are at a deja vu situation. So therefore, as we are looking at this event, I'll just take 2 minutes to pose, and I will not pose individual questions because it's a large panel. I'll pose common questions, and I hope each of them will take it up. And then we'll see if we can have time for audience as well before lunch. One is, do we know the customer enough is a question that I'd like to ask, because every time we talk about a crisis, we say that the solution is in the RBI guidelines and SRO guardrails, which means that we create problems internally and outsource solutions. So in that sense, we need to look at what do we know about our own customers without using the crutches of the credit bureau or the SRO? Can we put SRO out of job, and can we put credit bureau out of job? If we are, I mean, in fact, the SRO itself is an oxymoron. What is a self-regulatory organization? I mean, you're regulating yourself. I mean, so why do you need an organization to regulate? I mean, so that's one provocative question that I'd like to ask. Two or three things. One is microfinance or the inclusive finance has defied broad economic logic. What is the economic logic? You would find that if there is excessive supply, you would find that there is a price war. Unfortunately, here that has not happened. So that's something that I'd like to sort of put on the table. Visited Medak, Nizamabad, Hassan, Tumkur and Varanasi districts in the last month, 2 months. And every place I go, I find that there are 8 to 10 microfinance institutions active. And everybody is talking of either a crisis or overcoming a crisis or an impending crisis. These are the only 3 conversations that happen. And therefore, we need to look at how do we look at or reimagine this space in the customer segment. And the last thing I would like to put on the table is there were 10 licenses given for small finance banks. When I go to the field, even the small finance banks, microfinance operations do not have an identity of their own. And there's no savings there. So what are small finance banks doing with the licenses, and how are they treating the customer finances fully as a 360-degree service? So these are the 3 or 4 provocative questions that I leave you with. I am thankful to Sa-Dhan for inviting me. I don't know why they invite me again and again while I continue to be unpopular and provocative all the time. Thank you. Let's start with, I think Krishnadas, we can start with you and then we'll move on to others.
Firstly, thank you so much, Sa-Dhan, for setting this platform, and really privileged to be with senior colleagues of the industry. Thank you, Professor, for setting the tone. And just to start off and kick off the conversation, I think first and foremost, how much of customers we know, and we know mostly the customers from a transactional standpoint, right? Most of them, we actually go and do a transaction, and then you exit the transaction, and thereafter you wait for the next renewal to happen. So that's typically how I've seen this industry has panned out. And irrespective of whether you're a bank or a microfinance or a small finance bank, or even for that matter, PSU banks where there's a lot of SHGs being sold. So clearly it's more transactional in nature, and we've not really moved to a relationship-based model. While we talk about, having customers for multiple doses, we look at multiple cycles, but it's just transactional. So how do we move from a transactional model to a relationship model? That becomes a very important question to answer. As far as credit bureau is concerned, they have what goes to them, right? As an industry as a whole, we have a big role to play in terms of the quality of the data that goes. And that gives us a better sense of what a customer is bringing to the table. So one is, how do we move from transaction to relationship? And second, how do we make our data quality much better so that we can further use it? And then you have the alternate sources, which we will speak about it. But that's where I would like to pause and leave for the others to speak and add. But the question is, can we move from transaction to relationship?
Can we have Sadaf I'll go in this order. I'll look at the players on the field first, and then go to the service providers and others in the ecosystem. And regulator finally.
Thank you very much, Sriram. First of all, thank you for Sa-Dhan for creating this platform. I think we have a wonderful panel here. We have the regulator with us on the panel. We have 2 of the largest bank, public sector bank, private sector bank. We have some practitioner like me and HP sir, and we have insurance companies, and we have like credit bureau. So we have whole ecosystem here. And I think the question that you have asked, Sriram, is very, very pertinent. And when we talk about, do we know the customer enough? I think what we are trying to do is, do we understand the need of the customer? Like, why do customer borrow one loan after another, or like why do they borrow from 2 lenders or 3 lenders? Why can't one lender fulfill the need of that borrower? I think that is a more pertinent question. And I think it starts from the concept of microfinance as financial inclusion. I think we are moving from a stage where we were pioneers in financial inclusion and taking really the financial services to the last mile, to an extent where with the ecosystem evolving, your Jan-Dhan, Aadhaar, like your bank accounts opening, that's why I think most of the customers have financial access now, by and large. What we need to do is understand the need of our customer, whether she needs a 10,000 rupee loan or whether she needs a 1 lakh rupee loan or a 1,50,000 rupee loan. That is what is important right now. And I think that will happen only as we progress further and we move from financial inclusion to meaningful financial inclusion, which is if a customer needs to set up a small micro SME unit and she needs to buy some machinery, a 10,000 rupee loan will not get her. You need to understand her need and you need to understand the cash flow, her current cash flow and her cash flow from the business. And then you have to kind of provide her services. I think that's what is the need of the hour. And we might be in a crisis. I think crises are always a time of rethink and innovate. And I feel that this is the right time to move towards a level where you can graduate your customer. I think RBI has done a right thing to give more room for innovation from earlier qualifying asset of 75%, we have moved to now 60%. So there is enough and more room for innovation, but that is what is needed. And I think I'll go a step further. It's not only loans. The customer needs insurance, the customer needs saving, the customer needs your remittance facility, and most importantly, in today's environment is literacy, not only financial literacy, but digital literacy as well. So I think that is where the market is moving, and I think the sooner industry moves there, the better it will be, better insulated it would be. I think that is my opening remark on this.
Would you come in? Are you transitioning to individual loans with reduced interest rates also? That's an additional question that I'll put to you.
So let me first answer your provocations. I think, I think MFIs live in provocations, so I think, that's our life, so, I think for us, it's not too dangerous to get into this kind of a mode, But having said that, I think, I think it's very important to understand the evolution of microfinance. When you talk about being customer-centric, I think, what Mr. Nair said, yes, it's transactional, but look at the ethos from where it has come from. I think that's important for all of us to understand and gain. I think we will not probably say that microfinance was kind of an elevation of taking people out of poverty. I think it was probably making them come back into a organized financial and an organized credit system. I think that's probably was the first step of making inclusion happen for microfinance. Once that has happened, I think, it has evolved where what you rightly probably said, that for us, SROs and credit bureaus, regulators, everybody is a key piece to make sure that our customer centricity doesn't go down. Now, having said that, also, I think it's very important to also look at the basic tenets of microfinance. It's collateral free, it's unsecured. You suddenly have, maybe in the last 1.5 years, it's very pertinent to answer that, suddenly, unsecured loans, the halo just went away, because everybody said, but there's a cost attached to unsecured loan. It's difficult. It's not easy. That too, in the framework of the rural landscape, it's not easy. The cost of delivery, the way I think our loan officers technically operate, the various kind of mechanisms. I can probably honestly say, and I think, I'm probably a little blunt in saying that, from a practitioner's point of view, but it's not easy to operate in a rural landscape, where you have women across over there, you've got various factors which will probably, weigh you down in terms of how you operate and how you do things. So I think, rates are again, a mechanism of demand and supply. I think, if you'll have huge supply which will come in, rates will automatically fall down. But the cost of delivery, it's very also important for us, all of us to understand the cost of delivery is huge. The cost of credit cost is huge. So I think, if you put all the factors put together, I think, we are customer centric, but there's always room to do more, bring in more products. I think, the FOIA norms, the way we are looking at qualifying, non-qualifying, I think there's a breather now. So we have all these options coming up, but I think, moving forward, it's again an evolution to get better and better in this space.
Debasish, State Bank of India is the largest microfinance institution in India. If you just take your small borrow accounts portfolio, then you will beat all the other players hollow. How do you do it?
So, thank you very much. Thank you, Sa-Dhan, for inviting today. Already, I got applause from the stage when Padma Shri already mentioned about State Bank of India. Let me answer the first question. I'll come to the second one. So, if you go 20 years back, when you go to the bank to open an account, something called introduction was required. You carry an introducer and then you open a bank account. But who was the first introducer to the account is branch manager himself. So it's like head of the village or a sarpanch or somebody is introduced by the branch manager for the first account holder in the branch. So that time, there is no CRIF, there is no CIBIL, there was no credit information system, and banking was very simple and very productive also. Now in the last 20, 30 years of journey, we matured to different introduction, and Aadhaar is one of them. We have now something called officially valid documents, OVD, which is to be taken for opening account. The first onboarding of financial world is a bank account, if you understand that. Now, know your customer or know your customer for credit or liabilities, something has been debated over the years. We have now manifesto mule accounts, so many things happening, account at a service I mentioned during the off-site. So these are things that are now complicating the way we onboard the customers. That's why KYC or KYE or KYD or whatever you say KY related needs to have a bigger platform to debate and come out with a solution. Now coming to second part about banks' role in microfinance lending, I would say for the last 10 years, I myself have been very closely with the microfinance sector, be it Hyderabad, Chennai, Mumbai or Delhi, 4 places I have been working. So bank has been always very bullish on this sector for 3 reasons. Number 1, even if we want to go to those last mile, you can't because of our regulation, our operational efficiency to make it more productive. We'll have to depend on the microfinance units and the companies, the firms to take the banking to last mile. Number 2, we also find that these lendings have been building up to the priority sector of the banks, which is otherwise essential as a regulation for us to meet the sectors. And third, my own experience is I am finding that this is one area to improve the digital economy as well as social economy of the country. In all the 3 sectors, we have research papers by our economic research department that financing to microfinance units is directly impacting the bank's balance sheet as well as productivity. So for years to come, India's largest bank is committed to microfinance related investments. Thank you.
Let me go to Sanjeev. Tell us the role that an institution like Coverfox would have in this entire rigmarole that we are talking about.
No, thank you for actually inviting me here. Thank you, Sa-Dhan. I guess this is my 17th or 16th Sa-Dhan that I'm attending. So while, just to introduce Coverfox Insurance is today's probably the largest distributor of insurance and savings product for rural India. We work with, other than banks, almost every lending institutions in the country, be it MFIs, be it MSME lenders, SME lenders, and so on and so forth. I have myself been a lender. I have done micro lending as well as I have done startup lending. And it's a very interesting subject. We are talking about customers, knowing your customers, customer centricity. And Professor Sriram, you asked me what an institution like Coverfox is actually contributing. I am fortunate enough to travel the length and breadth of this country. I have also worked with SIDBI, by the way. I launched the fund of funds for startups there. PSB 59-minute loan, which is another remarkable achievement of SIDBI. I played a little role over there. So for me, inclusion, credit, distribution, rural India, hinterland. I myself come from a very poor village in Bihar, born and raised there. So the point that I'm trying to say is that I think the definition, you are almost right that why do we have a self-regulatory authority? We have actually two over here, Sa-Dhan and MFIN both, regulating a bunch of handful MFIs. Some of them graduated to small finance bank. One of them graduated to a nationalized bank. But we still have two regulatory authorities trying to regulate a sector. We were told that about 12 crore women have received micro-lending from microfinance institution. This, I'm assuming, does not include SFB and the banks. So if you add all of that, you are effectively talking about 50% of the country, almost closer to 50% of the country, that caters to, that is catered by microfinance institutions in some form, shape, or the other. Either you are an NBFC, you are Section 8, or you are small finance bank, or you are a bank, right? SBI is definitely the largest micro-lending and indirect micro-lending bank in the country. They are the largest bank. Now, what I understand about customer is that, see, the customer today in the village do not only require credit, they require a significant amount of low-cost consumption products which they actually require for their daily requirements. And to that extent, I believe that all these lenders, and why I'm always constantly saying leave apart bank, all these lenders are effectively one of the largest distribution company in the world, okay? India is the largest borrower market in the world, period. Micro distribution companies, not MFIs or SFB or micro distribution companies are bigger than Amazon's because they are catering the most humans that could have been catered by any business in the country or in the world, right? Now, the customer today requires everything. They require insurance which is beyond the loan tenure as well. Insurance which is at a lower cost of that they can afford, and they don't need to borrow money to buy that insurance. You will be surprised, Professor Sriram, that among the creditors, which is not bank, the group credit life that is sourced from the borrowers is almost equal to 175,000 crores by the insurers in this country. Now, that is a large sum of money, and you'll be further surprised that the distribution cost is almost 50% to that, okay? 50 to 55, 60%, in some cases, even 70% of the cost. Now, if you look at all of this together, there is a huge potential of bringing the cost to the customer down if we just change a mindset and we call ourselves as micro distribution company than a microfinance company, then suddenly RBI or your regulators which are actually regulating, nobody is regulating Flipkart which is doing 20,000 crores of losses, right? And if the NPA here crosses beyond 4%, 5%, there is so much news, right? So if we just change our perception and we become a distribution company, catering to that large mass of people, which is about 40 crore Indians, almost 40 crore women, what we are doing, Professor Sriram, is actually working along with the microfinance companies, because we cannot go to those 40 crore people ourselves. There we are selling products which are affordable. It starts from 50 rupees per year. And you'll be surprised that we sell health insurance at 500 rupees, which covers 2 lakh rupees for that borrower. Whereas another insurer with a bank, and the same bank is sitting in the panel itself, is selling the same insurance product at 2,500 rupees. So the distribution cost and leveraging this entire distribution that has been built over the last 30 years is actually not happening. If we can address that, then probably the panel will become more interesting.
Thank you. I'll just make a small interjection before I go to Sachin. that you said that nobody regulates Flipkart and this is regulated. One small difference. Flipkart and other FMCG transactions are what we call as terminating transactions. You do a transaction, you're done with it, whereas banking is a relationship transaction, you get entangled in it. So therefore, because you're getting entangled, it needs to be, and particularly if you're a vulnerable customer getting entangled, it needs to be regulated. So that's where the regulation thought comes from. I don't know why I'm talking like Reserve Bank of India, but let me sort of put that philosophy. Sachin, let me come back to you. One of the challenges, because, you know, when you go back, there is a lot of dependence on codified data, which CRIF gives or CIBIL gives or any of these organizations give. You're collecting the data, they're uploading the data, and there are guardrails. So therefore, there is a lot of dependence on you, a lot of responsibility placed on you for the problems that are there in the sector. While what you have is not complete information, essentially because there's a whole lot of SHG lending happening, there's a whole lot of informal lending happening, and there's a whole lot of informal lending through formal looking organizations happening in the field. I mean, I'm sure Sachin and HP will, Sadaf and HP will vouch for that. That there are people who pretend to be MFIs but not actually registered MFIs in the field as well. So how do you navigate this space? Are there any plans for you to navigate this space, keeping the customer interest in mind?
Sure, thank you, Professor. I hope I'm audible. Yeah. So first of all, thank you, Sa-Dhan, for giving us this opportunity. And we take pride in saying that, you know, Highmark was the first credit bureau born in India, Indian bureau, supported by all the microfinance institutions. And I think we have come a long way because it was a different industry. The search match logic, the addresses, the unified IDs, so it was so complex. And since 2011, since Highmark was set up and subsequently partnered with CRIF, we are almost like 14 years old, but what I can say, and I think many of our panelists would agree that, you know, there's a lot of maturity in what we get and how we produce it back to the people. So that level we have achieved. But definitely, as you asked the question, then there is still a long way to go. Because the purpose of existence of all of us is basically that how do we become more customer-centric, how do we provide more transparency, how do we provide more access to finance, right? And it's still a country is, you know, the largest population in the world, it still requires a lot more support than what we are able to provide. Now, having said that, the question you said is that, okay, we play a certain role. How is evolving? What more can be done? And I'll be very pointed on the question you asked. As of today, yes, see, we follow the SICRA rule. We are like a digital public infrastructure. We're in public-private partnerships. So we have some public sector banks who are our, you know, promoters or let's say shareholders, and then we have a privately held institutions. So in this model, following the SICRA rules, yes, absolutely, the country has evolved and we have been able to get humongous amount of data coming now every 15 days, and soon I think we are looking forward to work together with RBI to make it within a week or so. So basically that is becoming a, next to Aadhaar, if you take any institution which has data of 40, 50 crore Indians, and out of them, let's say 10 crore microfinance institution, you know, borrowers, probably it's the largest database after Aadhaar, right? And it is far more dynamic, right? Now, having said that, there are certain nuances which we need to look at it, because a borrower in a village or a rural economy or a, let's say, a kind of a lady trying to establish a business, it could be in Dharavi, it could be in a remotest part of the country, how credit bureaus are able to support the institutions to do that job, right? So basically, things have evolved in a way that till now, let's say, till I'm talking about till a couple of months back, it was like one size fits all, which means that a lady taking a loan in, let's say, a tehsil in Jaunpur would be rated the same way somebody would be, like I said, Dharavi, or it could be Surat, or it could be elsewhere, right? But thanks to the support from RBI, Finance Ministry, Madam Nirmala Sitharaman also talked about it. We have worked very closely with the, you know, SROs as well as with the RBI and others, and we have come out with a Grameen score, right? Obviously, it's in the evolution stage, but Grameen score was launched on 1st of October. We are in the process of rolling it out completely, and from 1st of December, the CIRs or Consumer Information Report will be available, and which would have a slightly different parameters to do. So when you look at customer side, a lady which is not having access to so many things or the literacy, it should be treated in a different way because she also deserves to get, funded, right? That's one part. Second part, you talk about SHG, again, a very important point. So there are about almost like a 9 to 10 crore people who are in SHG space, almost ratio of, let's say, 10 people per SHG, 1 crore SHGs. Traditionally, we have had a data of basically the president, secretary, treasurer, which we have been always taking, but nobody had a visibility beyond that, what SHG takes from a bank or typically public sector banks like SBI or others, what goes beyond that, right? Now, I think last few months or so, we have been working very closely with banks, with National Rural Mission, with so many other institutions which have been, we have been working in Locos app, which has been developed. I'm very happy and pleased to tell you that today CRIF has data of almost 50% SHG borrowers. Now, when I say data, data means two things. One data is that, okay, who is the part of SHG? Second data is about what are the trade line of that person. So what we have done is, thanks to the ecosystem, RBI and all the ecosystem partners, we have been able to reach a penetration of 50% of identification of the democs, right? Now we are still working with the banks, etc. Some of the banks have taken a very forward-looking statement that at the time of giving loan to SHG, they are also actually asking them that what loan is going to whom, right? And obviously it cannot be as accurate data as data coming from lenders on other portfolios, but it is improving. So today, the kind of products we have been able to build to improve the overall lending is that today if somebody takes a report from us, MFI, we are able to tell that whether the same person also has is part of SHG, first of all. Now it's a 50% accuracy level because I have 50% data. The day I get 10 crore data, I will be 100% accurate. That's one. Second is that I have a better accuracy there in terms of that, let's say if 50 lakh of them, I know that what they have taken and what they have paid. I will be able to also provide that data. Now that makes a KYC or underwriting far more superior because that has been a black box typically. I'll just take 1 minute more to throw light and I'm sure I'll get another chance. Just to tell the audience here and all the panelists, when we did our slicing and dicing of data, we realized that 40% overlap is there between SHG and MFI. So if MFI we talk about, let's say 8 crore or 7.8 crore as of today in our database, 40% people also have a membership in SHG. 40,000 crore of MFI, portfolio is basically with the members who have a SHG membership also. And let me also tell you, this is a blind spot because what happens is the loan is a loan. Overstretching, leveraging is overstretching, right? So if MFI is giving a loan in spite of 3 guardrails, if the person is already SHG loan as well, definitely it's a blind spot because what the person is already over leveraged and may default here, right? So that is one thing which is getting better and better with the SHG data coming in. On the other side also, just to add, basically, there are SHG and the retail. We did the analysis. 25% people in the SHG, the data what we have is basically are having a retail loan. And also MFIs are giving retail loans up to 40%, which is NBFC MFIs and then other institutions. 1.4 lakh crore loans of banks or MFIs have been given to people who have SHG account as well. And typically also I can tell you 25% of them are gold loans, right? So with this, what we are trying to do is that we are going deeper and deeper and deeper, trying to get this from the members and then trying to get it back to them with our analysis, improve our reports, including Grameen score, including this and that. And we are hoping that with the path is going on, we should be able to add more value. But yes, this is just maybe 2-3 steps, a long way to go. Thank you.
Can I go to Sudhata Mandal, sir? You represent SIDBI. SIDBI has been sort of the patron saint of the microfinance sector. Prijamon sir is sitting here. You were an institution which nurtured this sector when it was growing and it was doing meaningful this thing. What is SIDBI's view in the current situation? Is there a 2.0, 3.0 that you're looking at? How do you look at this sector and how do you look at your role in this sector, particularly with the reference to the customer centricity that we're talking about?
Thanks, and thank you to Sa-Dhan for inviting me. So when you talk of SIDBI, Mr. Maine is also here, right? So See, there are two angles to our engagement with the microfinance sector. One is through the microfinance institutions where we provide them term loan facility for against their pool of assets. We have also ventured into directly lending to the micro sector, right? Sadaf talked about meaningful financial inclusion. So there are MFI borrowers who have graduated from that JLG model and reached a stage where they require a slightly larger ticket size loan individually, as an individual and not as a member of the JLG. And that is what is fashionably called the missing middle segment. Identifying this credit gaps, we started a pilot project where we started lending to this segment in partnership with the microfinance institutions, wherein the microfinance institutions refer to us some of their borrowers who have successfully gone through 3-4 credit cycles and require a slightly larger ticket size loans. We take the entire risk in our books, and it is similar to a BC model where the MFIs are our partner institutions. So that book is gradually growing, though it is also seeing stress on account of the stress in the overall sector. But we are looking at ways and means of increasing the partnerships that we have, going beyond the microfinance institutions as our partners. And here again, we did another pilot with the cluster level federations. So that is as part of the SHG infrastructure. You have the cluster level federations now created as corporate entities which have been capitalized. So whatever role the MFIs were playing in this product, we are using the CLFs to play the similar role in the product. So therefore, they are referring the SHG graduates to us for credit. We have our BRE, we do our own assessment, and we take the entire credit risk on our books. And the cluster level federations are also responsible for monitoring and collection. So in that segment, that is something also which we want to grow. We started with 2 states of Bihar and Maharashtra. Now we recently signed an MOU with Assam as well, and we are in the process of rolling it out in the other states also. So one of the key elements of the other model where I'm using the CLFs, or if I'm using somebody else, for example, there is a talk happening of using the India Post and Payments Bank infrastructure, where the entire Dakia network can act as the business correspondent for generating credit requirements from the entrepreneurs or enterprises at the grassroots level and referring them to SIDBI. So we have the money to provide, and they have the network to do the collection, right? So whenever we use these kind of novel entities or firms as our partners, it is essential to impart training to them. That, for example, the Dakia as of now does not know how to handle credit, or the cluster level federation will not know how to handle credit. So we need to train them in credit administration. So we're using the services of WWB to do that for the time being, right? So there, I would also agree to what Mr. Nair mentioned about a relationship banking rather than a transactional banking, right? So if you have, any MFI has to have a commercial orientation, right? You cannot be doing business just for the sake of charity. You have to generate returns. But we also need to take into account the long-term viability of that operation. So transactional lending or transactional banking will help you scale up quickly, yes, but that is a very short-term vision, I would say. For a long-term sustainability for the same MFI and for the microfinance sector as a whole, you need to move towards relationship banking, wherein you need to address or assess the income at the household level and also the debt at the household level, something which I mentioned in my address in the morning. You also mentioned the requirement of having an SRO, right? Maybe that question is being asked because the SRO is not playing the role that it is expected to play. Now we have a regulator sitting here next to me. So this is food for thought for the regulator. You have the SRO which is brought in guardrails, for example, right? For example, not more than 3 lenders per borrower. Now what is happening, which has come to our notice in SIDBI, is that either there are banks, small banks, or the fintech lenders, or the SFBs, or the RRBs, who are lending to the same entity because they are not constrained by these guardrails, or alternatively, the MFIs who are bound by these guardrails, are giving the next credit to another member of the same household. So essentially, you're increasing or maintaining the increased leverage and at the household level, because the income gets aggregated at the household level, right? So therefore, we need to move towards relationship banking, understanding the individual's requirement, the individual's idiosyncrasies, what are his constraints, what is his source of income, how much of credit can he or she absorb, and then accordingly provide credit. It is easier said than done. Being a financial institution, it is easy for me to pontificate, but yes, I will leave that thought to the MFIs who are there on the ground to come up with ways and means of assessing that. There are several digital tools which are available. There is a lot of AI which is being used. For example, we are now going to launch a pilot product for providing revolving credit to very small enterprises. I don't know how many of you, most of you I'm sure would be aware of the Udyam Assist portal that we helped create, where we started giving out Udyam registration certificates in an assist mode. Because majority of the MSMEs in the country, more than 95% of the MSMEs belong to the micro sector. And the micro sector enterprises either do not have a PAN or a GST, or they do not file their returns. Therefore, a self-registration on the Ministry of MSME's Udyam registration portal was not possible for them, and therefore the number of registrations were fairly small as compared to the total MSMEs that are there in the country. So we came up with this solution of an Udyam Assist platform, where the lenders and the regulated entities who lend to these same set of customers, since they do their KYC and have the documentary evidence of their income and their investment level, which is the basis for the definition of small, micro or medium, that data gets uploaded, and we have created that platform, and more than 2.78 crore registrations have already happened there. So when we came up with this idea, the idea was not to end with giving them a registration and therefore onboarding onto the formal system, but also to see if we can provide credit to them. So we are in the process of, we wanted to set up a marketplace where we could provide credit to these small vendors, for example, the vegetable vendor on the street, who has an Udyam registration. I have some data about him on my Udyam registration portal, whether I can leverage that data and provide credit digitally to that entity, to that enterprise. So creating a marketplace has its own challenges, because the data is as of now not owned by SIDBI. Whichever is the uploading institution, for example, the MFI has uploaded the data is owned by them, and it is owned by the Ministry of MSME. We don't own it. So creation of a marketplace is going to take some time, but we are going to start lending on our own, wherein we are bringing in AI-based digital tools to assess the income of that entity, and therefore able to provide credit to them digitally. Because when you're talking of small value credit, you're talking of large volumes. It is not possible to individually assess the requirement of individual borrower and then administer credit. Your OPEX is going to hit the roof. Right? So what I wanted to say was that there are tools available today which help in assessing the income. There are, for example, if I take the photograph, it is a self kind of a upload. I can ask the shopkeeper to take a photo of his shelves and upload that on my app. My app will, looking at the photograph, will be able to assess his working capital requirement, what kind of inventory it is there. Now, there are chances of the borrower taking the photograph of the shop next door, right? So this app has the ability of distinguishing within a 10-meter radius whether it actually belongs to him or not. Right? So this is just an example that I'm giving. The idea is to use the digital tools that are available, very advanced tools are available, to then assess the income and the leverage of the household and not the individual borrower, and use these data to then provide credit. And I will request the SROs like Sa-Dhan to also act as filters, because there have been instances of diversion of funds, of frauds in the MFI sector, which we have come to notice in the recent past. And while I discussed with the SROs, I realized that this information was available to them. Right? But it was not shared in a structured manner with the lending ecosystem, the lender ecosystem. So therefore, the lenders would also start asking the question that you asked as an academician, that do I really need an SRO because it's not fulfilling the role that is expected to play. Right? So it works both ways. There has to be a collective effort of all the players in the industry to ensure that this microfinance sector grows and it becomes resilient. Because to reach the last mile, as SBI mentioned, the bankers like SBI or SIDBI or NABARD we do not have the bandwidth to reach the credit to the last mile. Right? We need organizations like the microfinance institutions to provide that credit to achieve the financial inclusion targets that we have. So it is our all collective responsibility to all work together and see how that sector can become resilient, plug all the loopholes, and bring in discipline. That is the key.
Thanks. That was a fairly comprehensive view. I hope what you do, the others will also learn. Till now you're nurturing organization, now you're doing things yourself. So hopefully you'll help the sector also to use some of your good practices as we go along. Mukesh ji, you represent RBI. So what can I ask you? What is the thinking that is going on in RBI? To the extent that you can reveal, please let us know.
So, Professor Sriram, this is a difficult question for me to answer. What is the thinking going on? Our ex-DG, Mr. Khan, is sitting here. They don't disclose whatever the policy decisions are taken. They are taken in a very closed door. And whatever is being revealed, that is revealed after due thought process is given. But at this moment, I can just cover few of the important aspects which is related to microfinance lending. So let me first start with the macro picture of credit landscape in our country. So as of March 25, the total loans and advances of the banking sector were at around 186 lakh crores. That is in rupee terms. And against the GDP of India in rupee terms was at about 330 lakh crores. That translates to credit to GDP ratio 56%. So this credit to GDP ratio 56% is far lower as compared to our neighboring countries like China, where it is 182%, South Korea, where it is at 164%, even Vietnam, where the credit to GDP ratio of Vietnam till 1999 was lower than that of India, but now it stands at 115%. Coming to the household debt to GDP, that is at about 40%, though growing share of the borrowing for consumption is a concern, but developed economies such as Australia have this ratio of 116%, Canada has 99%, Hong Kong at about 88%, and therefore these ratios are much higher level in developed nations, as against our credit household debt to GDP ratio of only 40%. So the government's Viksit Bharat mission, that is 2047, that projects that in order to achieve the GDP of $30 trillion, we need to have bank credit of $40 trillion. So that translates to credit to GDP ratio of 130%. So what I try to emphasize here is there is a lot of journey which needs to be traveled so as to become a developed nation, and microfinance will play a very, very important role in order to have an inclusive finance growth. So how can microfinance do? Professor Sriram also asked a question, do we know our customers enough? So there are different tools, as Mr. Mandal also spoke about different tools and ways and means of using technology, as a result of which we can have better credit assessment. So some of the tools which are there presently available, I can quote some of the example like account aggregator framework, unified lending interface. These are some of the tools. Then Grameen credit score, which was announced in the latest union budget, will supplement existing credit bureaus by helping evaluate rural borrowers. In South Korea, there is one Smile Micro Credit Bank that demonstrated that pre-lending consulting of just 3 days of monitoring and guidance can dramatically improve borrowers' repayment behavior. So the message is very clear: invest in your borrower's success and your portfolio will stay strong. Similarly, mobile GPS data. If we access the mobile GPS data of a customer and the customer is moving from his place of residence to the place of work and again back to the place of residence, that indicates that this borrower is a civilized and well-behaved borrower as compared to some other customer who is going from place of residence to place of work, maybe a construction site, and thereafter in the evening, the GPS data also shows that he also visits a liquor shop. So that's a red flag. So these kind of GPS and mobile data can be used for better credit assessment. Another important point is there is one study which is available on Google that EFL, Enterprise Financial Lab, and Equifax, they did a study in Peru wherein psychometric personality data that is used as proxy for credit scores, and by using that psychometric data, lenders were able to increase their lending by 140%, at the same time containing their NPAs by 50%. So these are some of the tools. With the help of these tools, I think the assessment of credit and fairly maintaining their book size, portfolio size, and healthy standard of their portfolio can be ensured. So coming to the RBI level, some of the steps which RBI has taken as far as MFI loans are concerned, RBI has reduced the risk weight for MFI loans from 125% to 100% and to 75% also if they qualify under the regulatory retail. There are changes in the qualifying assets criteria, which used to be at 85%, got reduced to 75%, and now it stands at 60%. Then the removal of cap on interest rates for MFI loans. That is, rule-based guidelines on pricing of loans have been replaced with principle-based framework. But that principle-based framework comes with more responsibility and accountability, and supervisors have to play a role in terms of monitoring that pricing framework. Threshold for housing loan has also been harmonized between rural and urban household to a uniform household income of rupees 3 lakh. These are some of the measures which have been taken by RBI so as to increase the lending for the microfinance sector. But at the same time, regulators' expectations are also there that they should be, the lender should adopt a developmental, empathetic approach rather than treating microfinance as a high-yielding business proposition. Regulated entities must strengthen credit appraisal framework to prevent borrowers over-leveraging. As Mr. Mandal from SIDBI was also expressing the concern, and the same thing we had seen during that Andhra crisis also, wherein one household was having as high as 10 loan portfolios. So these are some of the concerns. We should avoid coercive and unethical recovery methods. By being ethical, we can grow our business. The institutions can grow their business. At the same time, the society can also grow. So this is the method that ethics is good business. When MFIs act transparently, they price fairly and invest in their borrowers' growth. They don't just uplift communities, they build resilient, trusted, and profitable institutions. I think that is what I can mention at this stage. Thank you, Professor Sriram.
Thank you. With RBI, it's always a riddle. You'll have to read between the lines to figure out what is happening in Peru and what might be applicable to India. But nevertheless, thanks for the ishara. Akal mand ko ishara kafi hai. So we'll try and figure out what the thinking is. I think we have a little more time for one quick round of supplementaries before we go and see if there are any audience questions. I'll have a common question for both the mainstream bankers, Krishnadas and Debasish. How do you manage costs? Do you do any direct lending at all? Or is your microfinance portfolio largely bulk lending? If you're doing direct lending, how do you manage costs and how do you manage your distribution challenges?
So I'll take this question first. So we do both. We have a direct lending portfolio, also a indirect lending portfolio. Direct lending is again lending to the microfinance and NBFCs directly. That's called on lending. Also we have a large pool of self-help groups, SHGs, where we lend them directly for their own business, as you heard so many lectures about SHG, but that portfolio is definitely growing very high, and now we have 1.2 million SHGs financed by SBI of around 60,000 crores. A big portfolio of SBI in SHG. Now coming to indirect lending, also again there are two parts. One part is towards direct assignment lending. So that is again the MFIs and BFCs, we have to a kind of look at the portfolios created. Popularly known as pool finance, pool purchase. I think many of my clients are here only in this room, and the dais also. So that is a bigger portfolio than on lending. Also we started co-lending. So based on the RBI framework of co-lending, 80-20 ratio of co-lending portfolio is created. So all the four channels are equally growing. I would say that all the four are the priority of the bank to take it forward. And right now we reach a very, very matured level of on lending to every microfinance company or NBFC in this country. I'll tell you two more things in this. In addition to lending to microfinance, also we have a monitoring mechanism by ourselves. So all the books were maintained with us, gone through the risk management and credit assessment guidelines. And we follow all the framework of RBI in terms of NBFC financing, portfolio risk or collection efficiency. Many of the parameters have been regularized now, and we follow a regulatory and a comprehensive credit risk assessment framework for the NBFC financing. Point two is also we started now for the SHGs and for the small lenders, many digital lending models. For the audience here, we started a mechanism called business rule engine, BRE, popularly known for SME financing, up to 5 crores now. In the last 15 months, more than 1.93 lakh customers financed for 80,000 crores. The portfolio is growing every day. It's a totally digital model, digital documentation, and no need to go to any branch for the financing models. So this also back-end assess the models which are created for NBFCs. So for years to come, we'll keep on experimenting, revolutionizing the financing models as well as assessments. But as I said before, we're always bullish on NBFC financing. Thank you.
Krishnadas.
I think it's a very pertinent question as a bank. How do you manage this deep distribution? So for us, just to answer the first question, we are both in wholesale lending, which is on lending, co-lending. We also, securitization deals. Plus, we also have a direct lending, direct to consumer, the way the, let's say, current MFIs or any other small finance bank goes directly to customers. So the cost aspect is extremely important. And as you just rolling back to the earlier question on customer centricity and how do you know customer when you're going to operate in this model. So most important backbone for us is the digitization. We have a completely straight through processing. We don't have any paper. There's only one paper because of regulatory reasons, just one wet signature which is taken. Otherwise, end to end, right from eKYC to e-sign, e-stamp, everything is digitized. So there's no paper that really goes through. And most important thing is for the frontline sales, we enable them to understand the customer, the village, the locality, the local nuances that somebody needs to know at a tip of a, so sort of a click of a, on their phone. So basically a BYD approach which allows them to get a full view of that village, and that helps us to keep our costs low. That helps us to improve the productivity of the frontline without actually fishing around, going around asking for leads, which typically happens in any sales operating model. So that has helped us to keep the model. And secondly, the scoring models enable us to fine-tune the customer selection process. So we have an in-house model, which obviously has feeds coming in from credit bureaus, plus we have alternate data which we're trying to feed in. So account aggregator, which Mr. Mondal mentioned, right? We're already feeding that into our scoring model. We get a fair good of idea about the savings pattern of the customer. And we are also moving to the next level where we're talking about the mobile usage, which just somebody mentioned about, where it's important for us to know the trail of his and the patterns that he's following. So transaction, affordability, intent to pay, all of this in some form is stitched into this in-house model. And we're further, it's just about 6 months old and we're refining it to get deeper into it. And then add-on products like SHG, which the same team sells, which is again sourcing is far more easier, and those keeps your cost down. So optimizing the product mix and digitization, these two become very important tool to keep the cost low.
Thanks a lot. My common question to HP and Sadaf. Obviously, we don't, you guys don't have the luxury of cross-subsidizing and optimizing across products and so on. But my question is something different. Do you incentivize your field staff to degrow the portfolio in case they think that the customer is under stress irrespective of whether the guardrails are classified or not. Do you say that, look, if the customer is under stress, this relationship is not going to work out, it will go into a difficulty, but on paper everything is fine. How do you deal with this sort of a situation?
So the, sorry, I'll go ahead. So the answer is very simple, guardrails being there, that's one part, which you technically are following the advisory. We as an institution brought these guardrails maybe 2 years back before the actual guardrails came in. So that's one step which we took towards, looking at a stressed borrower and avoiding them. That's what we did. The other fact is, I think, we do understand that if your incentives are based only on disbursements, purely, I think this will lead to that. Our incentives are not linked to disbursement. In fact, if we talk about our incentive policies are more towards the coverage ratio. It's more towards your getting the borrowers paying on time and the center attendance. And that's a very important factor which is probably there. I think, you tend to lose this accessories along with the growth which you are trying to do. So for us, growth is not related only to disbursing. I think growth is related to how we are actually addressing the needs of the borrower, how we are doing the collection mechanism, what are various tools which we accompany them. And we do a lot of data mining, because for us, probably, we are very strong on technology. We do a lot of data mining. We look at how the center attendance is panning out to be, what are the various geographies where we feel that there is a stress coming on from a certain pin code. We tend to address that so that we are able to address not just pure the growth mechanism, but I think all other accessories attached to that, which are far more significant rather than just looking at pure growth.
Yeah. To answer the same question, I think this is probably one industry, microfinance, where it's heavily incentivized to not to leverage, not to give loans to leveraged customer. Because here, the person who's sourcing the business is also responsible for collecting the installment. So he knows that if he's going to give a loan to a over-leveraged customer or a customer who's intending to default, he will have trouble to collect that loan. So that is fundamental of it. But to kind of operationalize it, we also make sure that the focus is not only on incentivizing more disbursement, it is towards getting new borrower into the system, that is first time credit, first time they are borrowing. So that is where the incentive is, and also mostly the incentive is ensuring that all the parameters, that is loan utilization is done for whatever intended purpose is there, attendance in the center meeting is there, and also the collection is on time. It's not only about like whether they are paying or not, but it is on time or not. So those are the parameters we work on incentive. But I think what is more important today, I talked about it, that to understand what the borrower needs is, I think GRTs, CGTs have been a process in microfinance for a long time, but I think we need to move towards a more intense personal discussion with the customer. And we are using a tool, I don't want to be sounding like advertising something here, but we are using a tool where we are able to have a conversation on a structured kind of a questionnaire and get inputs from the customer. Those are on vernacular language. That conversation gets recorded. That recorded conversation, the transcripts are then converted into English, and then they are made into credit appraisal memo. And the questions like, what is your average income, what is your monthly income, what is your daily income, what are your expenditure, is it a rented house, and stuff like that. And then you make a credit appraisal memo. The most important thing here is to standardize the decision making, because at the last mile, the employee who's coming to us is usually a person who's, this is his first job. So make sure that there is a standardized decision. It is important to have some sort of an input. So that's what we are doing, and we are making sure that there is a centralized decision, there's an informed decision. We use aggregator information, we use credit bureau information, and of course the personal discussion information. a certain amount of psychometric test as well we use. So all of that is used to make decisions. And intention is always to make sure that customer who's getting a loan deserves it, and definitely she is able to service it, both on the capacity side, capability side, and intention side.
Okay, the story one is getting from all the panelists, including RBI and SIDBI, is technology is the way to go. I mean, that seems to answer both the risk cost as well as the distributional cost. Interesting. I'll go back to Sachin. Sachin, your data captures data at the individual level, or all the guardrails and advisories are at the household level. And you also alluded that, you know, new loans are given to the same household on a different name. Are there anything that you're using as far as technology is concerned to red flag that there is a household which is over-leveraged, or you'll do that only if you're paid?
So, Professor Sriram, we always do anything.
Possible for you to figure that out?
Yeah, absolutely. So so first of all, you asked a question with a little bit of a lighter note on that, so I'll also start with that. So we have decided to do anything and everything only when we are paid, because that's what RBI allows us to do. So I think I answered that first. Okay. Now coming to the flags, yes, I think fraudulent activity by design or by, let's say, circumstances are very much prevalent in the lending industry, and that's where we do have a platform which many of our lenders use. We call it a Sherlock. The name of the platform itself is called from a detective point of view, right? So its job is to detect that what kind of fraudulent activity is happening, what kind of over-leverage is happening, are there duplicate, IDs are being used, etc., etc. So that is one way to do it. But on top of that, there are many other ways are coming now. We did discuss in the pre-panel that, mule accounts have become the very important aspect. And in fact, I was listening to our, colleague from, or panelist from SBI, when he talked about in the first thing that, there used to be an introduction of somebody, then only account would happen. Now, very interestingly, the whole concept has converted into that I don't need to introduce. I will hand over my account itself to you, and you pay the money to me. Now that's called mule account, and that's prevalent, and we discussed that. So that's a very important aspect. So fraud is always there. Now question is that how do we tap it, and data comes very handy because we have search match logic. We always try to detect that are there two PAN cards, are there two voter IDs, are there same person, same father's name happens, and these gets flagged. So that is one. On top of it also that, like I mentioned, that there are a lot of data crunching we are doing, and we are bringing it out in our reports, which is standard reports. Let's say now we are going to mention going forward that irrespective of whether you want to look at it or not, but we will mention that the person is in SHG or not, right? Now it's up to your underwriter's interest or your company's interest to figure it out whether you would like to take another, like Sadaf talked about, that is a part of the discussion. Maybe that's also part of the discussion that, in the report, the person sees that there is a SHG, and then the person goes more in detail and figures out like, how much you have from SHG, what do you have it, right? So these are definitely the areas we are working on. And but yes, in SICRA rule, we are not allowed to make certain outside calls for PII data, etc. We in fact have another things also on the GST data. We are making representations and discussing with RBI and METI on that as per DPDP requirements. But some of those things are, if it comes in future, I think our ability to predict such kind of challenges would become a far more. Yeah. So that's where we are right now. And just another 30 seconds. I think the technology part is rightly mentioned. I think one is on the BRE side, second on the account aggregator side, because as a CRIF we have account aggregator also. We are seeing a tremendous amount of benefit because it's not about only underwriting. Actually what happens is that account aggregator allows you to ping the bank account for a duration of the loan. So you are able to see that if there is a income, falling, or if there is a check bounces happening, then, or any defaults happening, you are able to see those signals, which in bureau will show you only after 30-35 days, whereas in account aggregator, you will be able to cross-step the data, and you may be able to see it much faster. Yeah. So that's another thing. Yeah.
I'm tempted to ask one supplementary, but I will not. But let me leave the question with you, don't answer it.
No problem.
Would you incentivize by lower pricing for asking household data? I'll ask that question and I'll move on to Sanjeev. Sanjeev, only I have one question. We are running out of time, so I'd appreciate if it's a brief answer. How do you settle claims, particularly if you see this as a nice distribution model? Health, I mean, I can understand life is easy to settle claims, but health, how do you settle claims? Given that you're doing 500 rupee policies.
Yes, no, it is a very interesting question. First of all, we don't settle claims. We are an intermediary. However, our job is to ensure that if we have sourced a policy through any distribution network, we must ensure that the rightful claims are actually processed. That's we do. My team is here, and I may not know the exact number, but annually we should process about 300,000 to about 350,000 claims, all digitally, using all kind of machine tools and artificial intelligence that we do. But you'll observe one very interesting point on claims that you have, and I must make this point. We sell insurance all across, right? I mean, but a significant part of insurance that we sell is all attached with the loan. In our terminology, it's called affinity model. But effectively, every loan, every unsecured loan in particular, when it is distributed, there is a life risk attached to that borrower. And that life risk is not only to that borrower, but to the spouse as well. So it's a joint coverage that happens. What we observed is that majority of the microloans are for a tenure of 2 years to 3 years, right? And when we started doing insurance in that space, I'm not an insurance by profession, it's just by accident that for the last 4 or 5 years I have come into it. What we realized was that if you break the loan into 4 quartiles, right? So if you have taken a 2-year loan, a borrower like me has taken a 2-year loan, and I pay installments every month, and we observed that the claims largely comes in the last quartile. Okay, now what happens really is when the insurance...
This is for the life.
This is for the life, yes.
No, my question was about health. Life is easy.
No, in health is actually much more easier. Life is very difficult. Life, there is fraudulent.
No, please answer the health question. Please answer the health question. How do you settle the health claims?
No, so health, first of all, we don't settle. We are
No, how does the customer settle the health claims?
They get the claims. So I said we settle roughly 350,000 to 400,000 claims a year. So
now, what is the process? That is the question.
The process is that the borrowers who have actually taken insurance, they would need to, and they are all not cashless, they are reimbursable. So they have to take the invoice in whatever form, shape and manner that invoice is.
Are there approved hospitals or they could go anywhere?
Unapproved hospitals as well. We need genuine invoices, which then we process it ourselves and then we submit it to them. No, but you must hear the...
No. I mean, we are running out of time, so...
You may, okay, that's fine. But you are actually losing on the most important part of it.
No, it's okay. I mean, health is fairly simple, so I don't think we need to belabor that point. I'll open this up. I mean, obviously, I'm not doing follow-up questions for both CDB and RBI. But I'll open it up to audience. 2 questions before we close for lunch. One there, one there. Yeah, that's about it. Yeah. Please go ahead. Yeah.
I'm sorry to interrupt here. Can you use the microphone, please? It's placed. May I request the organizing team members to just direct them to the microphone, please? Ladies and gentlemen, the microphones have been placed for all our convenience so that we can use the microphone to direct the question to our honorable dais. Microphone, please.
Yeah. Hi, this is Satin here. So in the previous session, CMD NABARD pointed role of climate impact in part of the current stress in the MFI sector. So the question was, if you look at this from a financial resilience perspective and growth in the financial status that even the DFS secretary talked about, can SIDBI, for example, play a role to support more effective SME insurance product design? Can instruments like a claim guarantee fund or premium subsidy play a role, like you have credit guarantee? And in that, SIDBI and NABARD could also support awareness creation beyond the current, the government schemes, PMJJBY, etc., for, more AI-led products in cattle, agri, etc. And then Professor Sriram, some of this, yeah.
The next question, please. Yeah. First him and then, quickly.
Good afternoon. I am Kumar from John Morrison Co. So we are talking about mainly on the customer-centric with regard to loan, the transparency and all. It's fine. But with regard to that, if you are just seeing the customer pattern of, that the responsibility on the, repayment, if you see that originally when it was SHG, it was fine. So there was a slight drop, so only we moved to JLG. That model we have to. Of late, if you are just seeing that one after the state governments are imposing certain, this one, what is happening, though it may not be directly for the customer center.
No, what is the question?
Sir, question is that one, after the state government had restriction and all, there was a big fall with regard to the recovery.
Okay.
And it almost resulting in the technical write-off. So it is also eroding the NBFC's base net worth itself.
Okay.
How much they will be funding that one? What kind of a protection the government and also, the regulators will be helping for, because NBFC is funding.
No, but what is the question? I mean, who should answer? What is the question? I didn't get the question.
Sir, question is that one, how the NBFCs will be protected?
Okay.
This is the question.
Yeah, I'll hand it over to HP for that. Yeah, one more question, please.
Good afternoon. I am Rohit Neeraj, a student from Jawaharlal Nehru University, New Delhi. So my question is particularly on QA norms, qualifying assets criteria. So if you go back to YH Malagam committee, it was recommended 90, then RBI initiated to 85, then in 2022 to 75%, and most recently the QA to 60%. So on this context, that how this continuous reduction in QA threshold is impacting both the financial and the social side of the microfinance institutions in India.
Thank you. So for you first, HP next, and Mukesh next.
Okay. On the first question, the role of institutions like SIDBI and NABARD would be more in terms of the awareness building, right? In terms of the insurance products that are available or could be made available to mitigate the climate-related risks, that is for the insurance sector to do. I'm sure there are several products now available in the market which give you insurance from climate risk events. In terms of the awareness building, yes, that is important, and we as a financial institution are doing that. But having said that, it is still, in India, it is still at a very nascent stage. RBI has come up with guidelines in terms of factoring climate risk in your risk assessment and therefore the pricing. Now, for the microfinance sector, that becomes a bit too difficult. It is easier for the mid-corp or the large corporates because the awareness, the understanding and the ability to absorb the pricing is also there. For the microfinance sector, it is more of a livelihood or a sustenance financing which is provided. So there, if you want to bring in the climate risk assessment and therefore you price that risk and include that in your interest cost, it's going to be difficult. So we have to be practical. We have to find ways and means. I'll give you a very small example that we also do field visits. I have visited many of the direct beneficiaries of the microcredit that SIDBI provides. And there I have seen that the pollution control norms are not strictly followed. Now, as a banker, the first question would be why it is so, why it is not being followed. So I must ensure and insist that the pollution control norms are strictly followed. But on second thoughts, you realize that these are, women who are running enterprises from their households, from their backyards. So for them, livelihood and sustenance of that livelihood is more important than meeting the meeting the pollution control norms and spending on that, because it requires capital investments. So there has to be an awareness build up. There is a lot that we need to do. There's a lot of ground we need to cover, because yes, in the short term, it would entail higher investments and therefore more financial hardships. But perhaps in the long term, it will be more sustainable. It will help them to continue to grow their businesses. But coming back to the specific point of insurance, there are certain products, and more products are gradually coming into the market in terms of the insurance towards climate risk events. And we as lenders have to ensure that this kind of awareness is there and try to see if we can embed these insurance products along with the finance products that we give.
Yeah, so let me just, add on to what you said. I think the specific natural calamity insurances, which, become a group insurance policies, the amount is very minuscule, like about 200, 300 rupees. It covers close to about 50,000 or about 1 lakh rupees of a natural calamity. So that's probably the kind of, products we have in the market, and we are doing that. I think, Muthoot is also doing it, so it's there. On the question of the state government or the administration, probably what's the protection? I think the protection is sitting right here. We get protected by, talking about this with our regulators, with, the stakeholders and everybody. I think it's very important for, the whole, this topic of customer connect. I think, it does make a difference, If you're just banking upon maybe the secretariat or the administration of the state government to probably jump in and do everything possible, I think it's very difficult. So whenever there's something like that which happens across, I think, the regulator is aware of it. We make sure the SROs are aware of it. They take, proactive steps in trying to look at how we are able to minimize that. But at the end of the day, I think it's all about your connect with the customers. Whatever which is not technically legal enough to be there, I think, the borrowers will address it themselves, rather than, having kind of a protection for individual MFIs or maybe the NBFC sector as such. That's what my thought is.
Thanks a lot. Thanks. Mukesh.
So on the qualifying assets criteria, which has been brought down to 60%, it has to be seen from 2 points of view. One is the availability of credit, and second is the sustainability and the health of the lending institutions. So from the availability of credit point of view, though it has been brought down to 60%, but at the same time, the ratio has been increased from 10% to 25% for all other institutions which are not the pure MFI institutions. So the availability is taken care of by way of increasing the ratio for the other lending institutions. At the same time, since the microfinance institutions, they deal only in one particular product, so therefore any kind of stress is a concern for the health of that institutions. Therefore, it will lead to diversification and long-term health of that institution. I think that is what is the point which I wanted to make. Thank you.
Thank you very much. Thank you, ladies and gentlemen. I'm sorry if I've been a little curt here and there, but we come from the microfinance sector where we value discipline over anything else. And I've been getting notes and warnings from the side saying that you have to end on time. So thank you very much, ma'am, for warning me, and we are ending hopefully slightly. Yeah.
Thank you. Sir, you just got a compliment that you're perfect. Thank you for an exceptionally interesting session. Ladies and gentlemen, a huge round of applause for our eminent speakers of the session for making it very illuminating for most of us. I'm afraid we are running short of time here. We could have always taken a few interjections, but we can make use of the networking breaks that we have. We can exchange our thoughts with our experts. Thank you once again, ladies and gentlemen, on behalf of the organizing team members. Just to make this moment a little more memorable, we like to present mementos to our distinguished speakers of the session. And to do the honors, may I request Ms. Surekha Marandi, who is the former Executive Director, RBI, and board member, Sa-Dhan. Ma'am, may I request you to kindly join us onto the stage to present the mementos with huge round of applause. We first welcome Ms. Surekha Marandi. Warm welcome to you, ma'am. Presenting our first memento to Mr. Sudatta Mandal. Thank you so much, sir, for being with us, presenting a memento to Mr. Sudatta Mandal. We thank Dr. Mukesh Kumar. Thank you so much, sir, for joining us and sharing your thoughts with us. We now present a memento to Dr. H.P. Singh. Thank you so much, sir, for your valuable thoughts. A heartfelt gratitude to Mr. Sadaf Sayeed. Thank you so much, Mr. Sayeed, for sharing your thoughts with us. We also now thank Mr. Sachin Seth. Thank you so much, sir, for joining us and sharing your valuable inputs with us. We now present a memento to Mr. Debasish Mishra. Thank you so much, sir. And a heartfelt gratitude to Mr. Krishnadas Nair. Thank you, sir. Thank you once again. We also thank and now present a memento to Mr. Sanjib Jha. Thank you so much, sir, for joining us and sharing your thoughts with us. Ladies and gentlemen, now is the moment to give a huge round of applause to the moderator of the session, Professor M.S. Sriram. Thank you so much, sir, for wonderfully conducting and concluding the session. Thank you once again. Thank you so much, ma'am, for doing the honors. We would now request Gigi ma'am and sir to kindly join us onto the stage to present one more memento to our Honorable Partner PwC, Mr. Asim Parashar. We now present a memento to Mr. Asim Parashar. May I request Mr. Parashar to kindly join us onto the stage. He's joining us from the left of the stage. He's coming onto the stage. I request Gigi ma'am and sir to kindly join us on the stage and present a memento to Mr. Asim Parashar, who is Partner PwC. Thank you so much for that wonderful presentation in the inaugural session. Ladies and gentlemen, a huge round of applause as we present a memento to Mr. Asim Parashar. Thank you. May I now request all our distinguished members present on the stage for a group photograph and requesting our friends from media to capture this in our lenses and of course this stays in our memories. With that, we are coming to the concluding moment of this wonderful plenary session 1, customer-centric and responsible lending through fair, transparent, sustainable lending practices. We now break for lunch. We request you all to kindly join us back in